obviously you kind of summarized your approach to the stock market in your opening remarks. But I'd like to hear any other thoughts you have on it. But I'm also curious, in your opening remarks, you talked about, even though you feel like the recovery will be quicker than it maybe was during the Great Recession, that there will be some structural damage to the economy. And I'm wondering if you could talk about what kind of longer term structural effects you're talking about and how that could affect kind of families, business owners, and investors.
Sure. So let me comment on a few things. First, the stock market, while it's at all-time high, we need to understand something really important, and Connell kind of pointed this out, that the recovery in the stock market is uneven. So if you look at the top 10 stocks, and we all know the names, Apple, Amazon, Alphabet, they're up like over 30%. Yet if you look at the rest of the market, think of it as the S&P 490, it's down. Okay, so this is a really uneven recovery in the stock market. And yes, I do think that Sarah's point about the Fed put, and that's the idea that there's kind of a floor for the stock market, and the Fed is very careful to watch the stock market ever since maybe 1996 and Alan Greenspan. So I agree that that is a really important force. However, it doesn't really apply to most of the stocks. Many companies are struggling. And what we've seen is a surge in the so-called growth stocks. Okay, so that's the number one thing, that this is an uneven sort of recovery in the stock market. But nevertheless, we're at an all-time high, and it's really hard to understand how we got there. So I go back to March, and that was the month of maximum uncertainty, where we didn't know how bad this pandemic would actually get. And at that time, the stock market plunged 35%. And it was also interesting that assets that sometimes would be considered safe haven assets, like gold, plunged. And the new gold, supposedly, Bitcoin, the cryptocurrency, it lost over 50%. So at that time, people were fleeing risky assets and investing in safe assets, cash and government bonds, and the rates went down. But then when the uncertainty started to be reduced, the Fed came in with this unprecedented sort of monetary policy where they're actively in the market buying risky assets. It became a situation that's known as, quote, risk on, unquote. So that meant that people started to pile back into the stock market, including some of the retail and speculative investors. People started to buy gold, and people started to buy Bitcoin. And look where we are right now. The stock market at an all-time high, gold near an all-time high, and a 100% return on the cryptocurrencies from the trough. Okay, so this is a situation, again, of speculation, uneven speculation, and I think that we're not viewing the risks in a balanced way. There are real risks out there. So the quantitative easing, in contrast to the global financial crisis, this quantitative easing is unlimited. And we've never been in a situation like that before. We've created an unprecedented amount of money. We don't see any inflation right now, and the expectation of inflation is about 1.6% over the next 10 years. However, that could change. And if there is a surge in inflation, that's going to be very negative for businesses, and it will be especially negative for the people in our society that are the most disadvantaged, because inflation is a tax. And those that pay for it are those that can least afford it. And that poses a structural risk to the economy. The other issue that's very important is on the fiscal side, where we have not hesitated to spend, we have not hesitated to take more debt, we don't have a rainy day fund because over the last 10 years, in positive economic growth situations, the federal government has chosen to run a large deficit. If they had chosen to run a surplus, we might have had a rainy day fund. No, we don't have that. And I agree that we have basically put this onto the next generation, and that creates a structural issue in the longer term and in the shorter term, because many companies have taken on debt. And one of the risks that I see that I've talked about in my LinkedIn is the so-called debt overhang problem, where a good high quality company to get through the crisis has taken on debt. And they've got perhaps a good idea, an innovation that maybe could return 30% per year. They go to their bank and their bank says, we can't lend you the money to finance this because you are over leveraged right now. That project is never pursued. And what this does is eliminate these opportunities for high growth projects. These are the projects exactly that can drive us out of this recession and put us on a course to higher growth in the future. Yet this debt overhang negatively affects companies that could positively contribute to the recovery. So those are just like two aspects of the structural risk. The third one is kind of obvious, that in the short term, we've seen bankruptcies. But the bankruptcies we've seen, you could characterize as accelerations of something that was going to happen anyways. So we knew that JCPenney is going to go bankrupt. Some of the big box retailers, we knew that they were going to go bankrupt in today's sort of economy. This was just an acceleration. The structural damage, the third level of structural damage, is when high quality firms that had a good future have to go bankrupt because they just can't get through this. The government policy has been trying to mitigate that and to minimize the structural damage. But at some point, given that we've done a poor job of mitigating the public health issue, at some point, we're going to see some high quality firms, and maybe they're not firms that we recognize the names of. There are so many small and medium-sized businesses that are so crucial for the economy, that are high quality, profitable, contributing positively to economic growth, that will go under. And that will negatively affect our prospects in the future.